8.8% a year. Global shares unhedged, so that's just using Australian dollars to buy global shares, 13.6% a year over that same period. Listed property, which was only really came about as an asset class in the 1970s with General Property Trust. It's measured from the start of the 1980-81 financial year, and global listed property from 1990. But that's still 17 years of data. I think the interesting thing from this is that it's pretty similar, and I actually think it might look even more similar now. I haven't got the 08 figures because, of course, listed property either fell sharply in value or spent some time consolidating, depending on how much of an optimist or a pessimist you are. But, it fell sharply through the year, and its return would have come back closer to the others and fell further than the other asset classes. The key point, I think, is that all of them have a similar long-term return. Therefore, is there a way of saying, okay, within our growth asset classes, can we use all four asset classes to try and reduce the overall volatility of the portfolio if we're going to get a similar long-term result anyway? So, now, okay, this is where we start to actually look at this idea of correlation, and then getting on to some of the practical questions I posed early on, as in, what are the future fund doing? How would we set up a portfolio to cope with volatility? Those things. So, if we start by looking at that first column, which is Australian shares, it then shows the relationship that it has with different asset classes. So if we look down that, we can see it's most similar, the 6664 in theoretical context, or this is actually using the data from 1990. So I should say where the data comes from. This comes from 1st of July 1990 through to the 30th of June last year. So it's 17 years of data. That's the most recent. And the reason we had to start the data at that time is because the International Property Series only goes to then. And I've pinched it from a Vanguard investment. I'm using it with permission. International shares hedged are most similar in their movement with Australian shares. At a correlation of 0.66, they're not perfectly correlated, but there's a lot of similarity between them. If you look at the first one down, Australian equities with international listed property, correlation there is 0.3122. So it's actually the most dissimilar of what I would call the growth assets. So by growth assets, I'm referring to the shares and property, those assets with a higher expected long-term return. So the least similar is international listed property. So there's the greatest diversification benefit from having that. Do we see that come in practice? It's actually very interesting. But international property has actually had a pretty reasonable 6 months, even while Australian markets have been pretty poor. They've had a much better 12 months than Australian property, and so in a practical sense, we are seeing some diversification benefit from that asset class. Other ones, you can see Australian listed property is quite dissimilar generally, so 0.5, so certainly some correlation benefit there. Probably the most significant practical example of that was 2001-2002, when Australian shares were really struggling, but it was a period of reasonably good returns in listed property markets. This time around, they've certainly fallen in lockstep. It's been a significant downturn overall. A couple of other things, emerging markets is an asset class that's getting more attention, and there's a certain amount of a diversification that comes there. Another interesting point for investors who are looking to invest in international shares is the question, should we use hedged or unhedged exposure? So if I explain those two terms, if you invest in international shares, you can either just use Australian dollars to buy assets overseas through what they would call an unhedged share fund, or maybe directly. And you're exposed both to how the portfolio performs and any currency fluctuations. The other way is to invest through using their dollars, using a hedging situation, so the currency fluctuations are taken out, unhedged. both have very similar long-term returns, and you can see when you look at international shares unhedged, 0.4671, less correlated than international shares hedged. And so you'd say if you're looking for the smoothing effect, you're getting a bigger diversification effect by having unhedged rather than hedged shares. Although you might say there's an argument maybe for having a little bit of both in a portfolio and getting even more, because they slightly, move slightly differently. So having a look at the theory and some of the returns. And can I ask then, I guess the other point to make in that is looking over at fixed interest and cash, because they play such a key role in portfolios compared to growth assets, which have a higher expected return but are volatile, and that's so clearly demonstrated in markets at the moment. And I think one of the interesting things about, painful but interesting things about markets at the moment is the fact that there were a certain number of people who were advocating the kind of a weight of money argument and an information flow argument, and were saying, well, look, with all this superannuation money going into share markets and equity markets, they're going to be more reliable. They're going to be less volatile over time. But I think it's interesting to reflect on that sort of argument now, and we'd have to say this is a significant market downturn and as significant in terms of negative annual performance as any going back to 82. So that argument seems to have been debunked a little bit by what we've seen happen in markets. But if we look at Australian equities, again looking at that first column, and we compare it to cash and fixed interest, we can see that they're pretty uncorrelated. They move pretty separately, and that's not surprising. We expect cash and fixed interest, cash particularly, to provide a nice, steady, reliable return. And one of the nice things about the investment environment at the moment is that banks are kind of forced to offer us a higher rate of return than they have been for a long time, because they need our money to help fund their operations. But we can see when we're looking at building a portfolio that we can think of those things as being pretty separate from how equity markets and growth assets move. So I want to bring back to the